So you click buy on a stock. Boom. Feels instant, right? But behind that one little click, there's this incredible high-speed journey happening in a super complex financial world. In this explainer, we're going to track that journey step by step. We're going to show you what really goes on with your trade. And look, whether you're cramming for the SEI exam or you just want to be a smarter investor, you've got to know this stuff.
We are going to follow a single trade, from the moment the idea pops into your head to that final confirmation. It's a trip that literally takes milliseconds, but it involves a massive interconnected system. Let's break down exactly how it all works.
Okay, first things first, we need to understand the arena where all this action happens. Now, a common misconception is that you're buying stock directly from the company itself, like from Apple or Ford. But the reality is something else entirely. We're all trading in what's called the secondary market. You know, the easiest way to think about it is like a giant marketplace for used cars. Ford built the car once. That's kind of like the primary market, the IPO. But every single time that car gets bought and sold after that, between you, me, and everyone else, that happens here. So the company that originally issued the stock, they're long gone from these day-to-day trades.
So what's the whole point of this giant marketplace? Well, it creates one absolutely crucial thing: liquidity. This is the bedrock of the market. It's the confidence that if you need to sell your shares, there's going to be a buyer ready and waiting to pay a fair price, turning your investment back into cash almost instantly. I mean, without that confidence, who would want to risk tying up their money?
Now, within this giant market, trading happens in two main types of venues. You've got your centralized exchanges, and then you have the over-the-counter, or OTC, market.
Okay, so exchanges like the New York Stock Exchange or the NASDAQ, those are the big centralized locations. They've got really strict rules for the companies that get listed on them. The OTC market, on the other hand, is different. It's a decentralized network of dealers all connected electronically. And understanding this structural difference is really crucial, especially for the SIE exam. One is centralized, the other is not.
So, you know the arena and you know the venues. But how do you actually get in the game? How do you tell your broker exactly what it is you want to do? Well, this is where the order comes in.
An order is your official command. You have to think of it that way. Every single detail you include is a legally binding instruction for your broker, and they have to follow it to the letter.
And these instructions, they have to be precise. You've got to specify the exact security, whether you're buying or selling, how many shares, the price you're willing to accept, and even how long your offer should stand out there in the market.
This brings us to what is, I would argue, the most fundamental choice you have to make when you place an order. It's a classic dilemma every single investor faces. What's more important to you right now? Speed or price?
This is where you have to make a choice. A market order, think of it like a rocket. It's all about speed. You're basically yelling at your broker, "Get this done right now. I don't care about a few pennies, just get me in." In contrast, a limit order is more like an archer, taking very careful aim. You're saying, "Look, I only want to buy at this exact price or better, and I'm willing to wait." Now the upside, you get your price. The risk? Well, you might miss the shot entirely if the market never moves to your target.
So let's put this into practice. If you hear some breaking news and you want in on a stock immediately, a market order is what gets you in the door, fast. But if you've done your research and decided, I only want to buy this stock if it drops to $50, then a limit order acts as your patient gatekeeper. It gives you that precise control.
On top of price and speed, you also have to set a time limit. A day order is usually the default. If your order isn't filled by the time the market closes, it just, poof, disappears. But if you're willing to wait for your price, a good till canceled order will stay active day after day until that trade finally happens, or you decide to pull it yourself.
Okay, so your carefully crafted order is now in the system, flying through these electronic networks. But how does your broker decide where to send it? And how do they make sure you're getting a good deal? This is where a very, very important regulatory duty comes into play.
This is where a critical investor protection called best execution comes in. It's a legal duty that forces your broker to act in your best interest. They can't just send your order to a venue that's easy or maybe profitable for them. No. They have to actively hunt for the best possible terms available for your trade across the entire market.
But here's the thing. Best doesn't just mean the lowest price. Regulators require brokers to weigh a bunch of factors. The price, of course, but also the speed and the likelihood of execution. It's a balancing act, making sure you get a fair price without your order just sitting there unfilled while the market moves against you. It's really all about the overall quality of the execution. All right, so your order's been executed. You get that little confirmation, and you think the trade is totally done, right? Well, not quite. See, the execution is just the agreement to trade. The final, and I mean critical step, is called settlement. That's the official transfer of the stock for the cash. It all happens behind the scenes, but this is where the integrity of the whole system gets put to the test. So it leaves us with a really interesting question. What do you think happens if one side can't actually deliver on their promise?